From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable, and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we go into some details about jobs report that just came out, as well as the 50 basis point rate cut that took place, the first rate cut to take place in nearly 4 years. It's a big deal. It's a reversal of what the Fed is trying to attack. No longer worried about inflation, but instead worried about unemployment. And I go into some reasons why I think that might be a bad decision. Now, granted, we're not here to debate, nor can we change anything that the Fed decides to do. But what we do want to do is plan for your retirement to be successful no matter what happens in the stock market. This is why we go into a couple of sections about what you need to be focusing on for a retirement portfolio. First step, second step, and third step. We outline it all closer to the end of the show. I hope you enjoy this show. It's a little bit more detailed than we normally go with some reports and statistics, but it is very educational as we go through these things. If you have any questions or anything that our team can help you with, of course, give us a call, 270-600-PLAN, and we would love for you to rate, like, and subscribe to the show with an honest review on the podcast streaming service of your choice. So without further ado, let's get to this episode of the Retirement Matters Podcast called The Fed Cut Rates. Now what? Enjoy the show. Good morning to you. I hope you are doing well, and you're ready to start discussing all things retirement matters. This morning, we are getting into a lot of what's going on in the economy today. We're going to uncover some details. We don't typically go this deep in details, but I want to draw your attention to something that the Fed did this week that they have not done for over 4 years. They haven't done a rate cut since 2020. They've had no reason to do a rate cut, having battled inflation for the last 4 years, now feeling as if they've got it under control, and they are making a pivot in their monetary policy. We are going to get into that and the details of how that will impact the market as we go through today's show. So a lot of really good information for you, especially if you're approaching retirement. And at the end, we'll try to give you a couple pointers on what you should be doing to make sure that your portfolio can weather the storm that is likely approaching. One day or another, we will see these markets have a correction. Now, granted, this market that we are in right now has killed more bears than Davy Crockett. There is the idea that a bear market is a down market, and a lot of people are bearish in nature. They are always thinking the market's going down, always thinking the market's going to crash. And this market has defied all odds. In the last 12 to 15 months specifically, the market has slayed more bears, more people who are bearish in nature, has made them wrong time after time after time. And I'm not here coming to tell you that the storm or the crash is right around the corner, but I am telling you that when it happens, it could be big. And when it happens, you have to be ready. And this is what we put our attention to here at RDS Wealth. Every single time we talk to a client or every time that we look at a client's portfolio through reviews, we are making sure that it is ready to weather the storm. We've talked about financial winter, and on a normal financial winter, things get a little bit hairy. If financial winter is then coupled with uncertainties in the market or higher inflation numbers than we would expect, look out. And this is what I'm really wanting to make sure that you're aware of as we go into the coming 6 to 12 months. If you are looking to retire anytime in the next 5 years, be careful. Be careful how you're investing your money, because we are on the edge of something that could be big, and I want to make sure that you're okay. So we're going to get into that again later today. But before we jump to that, I have a story to tell you that I heard, and this will be our positive focus for the day. This is our pause for positivity. Now listen, what I'm about to go through is not going to be for every single listener. It may not be for you today, but you have likely went through a situation in life where this type of message would have helped you. You may be currently going through a situation in life where this message will help you, and it is very likely that in the future you will be going through a situation in life where this message will help you. So, in my opinion, this is something we all need to hear, and we would either need to deploy it today to get out of a situation in our mind that we're in right now, or maybe we just tuck it away and we deploy it later if we ever found ourselves in a situation where it would apply. So let's jump into it right now. This story is not mine. I've heard this story, and I want to share it with you. The story goes like this. There was a group of world champion athletes that were taking a tour through this museum in France. The museum is called the Louvre. And as they were wandering through the halls of the museum and the exhibits that they were seeing, there was a world champion chess player who was drawn to a specific painting titled Checkmate. This painting is a famous painting, which you can look up. It has one player on the right-hand side of the painting that looks totally defeated. His head is laying in his hands. He understands that he is on his last move and that he is likely to lose. And then the other player on the left-hand side of the painting is Satan. Satan is playing chess against this man, and it's obvious that Satan is arrogantly boasting as he leans back in the chair saying, "What is your next move?" So as time goes by, this Grand Master is looking at the painting with great intent, so much so that the museum guide comes over to see what he's staring at. And the Grand Master goes on to explain what he does for a living. He says, "Sir, I am a Grand Master at chess. I've played this game called chess that this picture depicts thousands of times. I've beat hundreds, if not thousands, of people at this game, and I have never lost in a world championship. I am the number one player in the world, and a lot of it is due to the fact that I'm able to see what a lot of people can't see on the board. I can see moves that are taking place before they even come to fruition. And I've got to tell you, this painting is flawed, or the name needs to be changed." And the curator looks at him and says, "Well, I don't understand. What do you mean?" And he goes on to explain, well, if this painting is called Checkmate and it is supposed to depict that Satan is winning, the artist made a grave mistake, because according to the pieces on the board, the king still has one move. And the curator looks with amazement as the Grand Master goes on. You see, the king has one move that not only allows the man to continue playing, but immediately flips the board, putting Satan in checkmate. When the king makes his move, in other words, Satan loses. It is now no longer the man who is in checkmate, but instead Satan himself. And I don't know if this was due to the artist being in error, or if maybe the description needs to be changed, because the king certainly has one more move. Now, I don't know if you're a very spiritual person. I don't know what you believe. But if you're like me and you believe that the King of Kings is who we serve, if you're like me and you believe that the Son of God came down and died for our sins, you also believe that the King of Glory fights our battles. And this is what we have to rely on. I don't want to make this a Sunday morning church service type of radio show, but I think someone may need that message. When you feel that you are losing at the game of life, realize the King has one more move. The king may have one more move for your finances, for your children, for your marriage, for your family, for your emotional well-being, or whatever situation you find yourself in. The king has one more move. And I believe that wholeheartedly. I rely on that faith. And I think that if you do as well, this type of story, this type of impactful meaning in the story could change your perspective. And if we all live with that perspective, if we all go through life understanding that, of course, life is challenging at times, but the king has one more move, this will make our day brighter. And I believe that if we can help ourselves be in a brighter place, we can then turn around and shine that light into someone else's life, and that will make the world brighter day by day, one person at a time. Remember, this week as you go through life, and perhaps life hits you unaware, the king still has one more move. And if you're interested, like I was after I heard this story for the first time, go ahead and Google checkmate painting, and it will show you the exact painting that I'm discussing. And if you're a grandmaster perhaps at chess, you'll see that the king has one more move. It's a pretty powerful story, and we're going to make that our pause for positivity this week. Don't go anywhere. We're coming right back with more Retirement Matters after this break. A lot of good information that you need to be aware of, especially if you're looking to retire anytime in the next 5 years. We're coming right back after this short break.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management, serving the residents of Kentucky and Tennessee. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. We are happy that you're listening in and hope you find value in this week's episode. If you'd like to listen to past episodes and find exclusive content and full-length interviews, search for the Retirement Matters podcast on the podcast platform of your choice, or visit us online at rdswealth.com. While you're there, be sure to sign up for our free weekly newsletter. That website again is rdswealth.com. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. Let's go into some things that took place over the last 4 or 5 days that you need to be aware of that will directly impact the market. Now, I understand that a lot of common individuals do not look at these numbers, but it's something that we do at RDS Wealth on a weekly basis. There are a lot of reports that come out, and we've had our ear to the ground on these recently because we've understood that a lot of turbulence has taken place inside of some key economic indicators, which means for you, potentially you may see that in your 401k over the next 2 to 3 months. Now, granted, we're going into October, so I don't want anyone to panic based off of what they see happen in the month of October. We have mentioned this several times on the show. October is financial winter. Don't sell good stocks in the middle of winter. It's not a good idea. So with that understanding, let's go into something that took place this past week that has not taken place in nearly 4 years since COVID, and this is rate cuts. The Fed decided to cut interest rates by 50 basis points, which is 1/2 of 1%. 1/2 of 1% cut. The market has already priced in about 1/4% of cuts. And surprisingly, when the Federal Reserve met, they decided to cut interest rates by 1/2%. Not 1/4, but 1/2. Now, traditionally, that would be a good sign for the market. Interest rates being cut tend to make markets go up. Why? Because money becomes cheaper. Expansion takes place from this. You've heard us talk about in the past that the reason interest rates got as high as they were is because the Fed was attacking inflation. Now they feel as if inflation is under control. And while I may differ with that analysis, the decision has been made. 50 basis point cut. Now, when I heard this number, I thought we were in for a really bad jobs report that comes out on Thursday of every week at 8:30. But what happened at 8:30 on this past Thursday was that we saw a better than expected jobs report. Now, if you're not a person who geeks out on these numbers like I do, I don't expect you to understand exactly what that means, but I'm going to try to make heads or tails of this. You see, we have a initial claims report that came out on Thursday, which shows 219,000 people filed a claim for unemployment. And that sounds like a whole lot of people. But when we take into consideration where we've been, this number doesn't look bad at all. And what I mean by that is right before we started to have rate hikes, our unemployment numbers looked almost identical to where they are now. So I'm curious as to why the Fed has decided that now's the time to start cutting rates so aggressively. If we caused rate hikes back then, well, why now are we doing rate cuts? And the number one reason is inflation. We were battling inflation back then. But all of a sudden, the Fed thinks that inflation is under control, and now we have to battle unemployment. And for any of this to make sense, I want to help you understand what the Federal Reserve's role is. The Federal Reserve is there, of course, to print money and distribute money. But one of their primary objectives, they have two main objectives. One is to make sure that inflation doesn't go off the rails. And their second mandate is to make sure that unemployment doesn't go off the rails. So we hear them talk about this dual mandate all the time. If you listen to Fed speak, you hear them talk about the dual mandate. And what that is we got to make sure that inflation isn't crazy high and that unemployment isn't crazy high. There's this perfect level of employment according to the Keynesian economic theory, which gets really deep into the weeds, but I would suspect that that's what the Fed subscribes to more often than not. And if I take that into consideration, I understand why they did rate hikes. Totally get the understanding that inflation was going off the rails, and one of their ways to squash inflation is to raise interest rates. Well, one of the ways to squash unemployment is to lower interest rates. And it all kind of filters through the system. Lower interest rates typically mean less unemployment. So the Fed decides that they are going to battle unemployment, which is not even really in a bad shape right now. And this is somewhat concerning because what it means to me is that it's possible that they see something that is not in the publicly disclosed numbers. Because if you think through unemployment with me for just a minute, if you have a macro view of unemployment in this country right now is 4.2%. Well, at the highs of 2008, it was nearly 10%. And at the highs of COVID, it was right at 15%. So at 4.2, if we decide to reverse course on inflation and start attacking unemployment, there has to be something somewhere that's close to breaking. Because to be real frank with you, inflation's not completely under control. And unemployment is not as bad as we would expect it to be at this stage in the economic cycle. Now, I get it. Unemployment is not good for anybody. But by all scopes and numbers that we look at the economy through, it's really difficult to see why we would have such a drastic rate cut. Unemployment is not out of control. But when you hear the Federal Reserve Chairman, Jay Powell, stand up and say we are recalibrating because we understand that we need to now attack our dual mandate, the other side of our mandate, which is unemployment, something gets a little bit finicky. And I'll be honest, when I saw the numbers come out with a rate cut, I expected that the jobless claims the following day, Thursday, would be really bad. I said to our advisor team, and I was even prepping for a TV interview the next day to talk about initial jobless claims, and I realized that, man, this might be a really bad initial jobless claims if we're seeing the Federal Reserve cut interest rates by 50 basis points. Now, I'm not here to tell you one way or the other that for sure we're going into a recession, but I am telling you that what took place with the 50 basis point cut is kind of like going into the doctor's office and them telling you everything is okay. We just need you to take this shot and we need to put you on this new medication. You haven't really been diagnosed with anything, but just do what we tell you to do. And I'm confident we would have some questions. And that's kind of where we are right now with the economy. We have some questions. Why exactly are we at a 50 basis point cut? Now, there are some positives to that. Interest rates going down mean the market could continue to climb. But my fear is that we're on the sugar high, and when we come off of it, we may see a sugar crash. And it's possible that you have probably experienced something like that in your own life with a sugar high and ultimately the crash that follows. I just hope that that's not what's taking place in the market today. So let's go into a break. And whenever we come back, we're going to reset. And we're going to discuss the debt and how that interest rates lowering help the national debt. We also are going to touch on mortgages and what we expect mortgages to do with this rate cut that's taking place. And then at our last segment, I want to discuss what you need to be doing with your money and how the plan that you are in right now needs to change a little bit if you're planning on retiring in the next, say, 5 years, just in case we enter into something called the lost decade. More on that when we come back. Let's go to a 1-minute break, and I'll see you on the other end with more Retirement Matters after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management, serving the residents of Kentucky and Tennessee. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. We are happy that you're listening in and hope you find value in this week's episode. If you'd like to listen to past episodes and find exclusive content and full-length interviews, search for the Retirement Matters podcast on the podcast platform of your choice, or visit us online at rdswealth.com. While you're there, be sure to sign up for our free weekly newsletter. That website again is rdswealth.com. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the Retirement Matters Show. You know, when I give the boys sugar, whether it's a soft drink or just sugar in candy or cookies, I am convinced that there will be a period of time of hyperactivity. That is part of it. They are going to be on a sugar high for a while, but what comes after a sugar high, if there's not more sugar to follow, is a sugar crash. And sugar crashes are a biological thing for sure, but emotionally, they're drained. They are very lethargic. They need a nap. They want to lay down. They don't feel like doing much. This sugar high lends itself to a sugar crash. And if I had to go straight from the analogy to what we're experiencing in the real world with the market, what the Fed did this past week with a 0.5 point rate hike has just given us another pixie stick. If we are on the sugar high with jitters, we are about to start to see perhaps the market come to a point of equilibrium, if not ready for a nap. And then, boom, here comes the Fed breaking into the room with another pixie stick. And that is a very good thing for investors, but it could be a detrimental thing for a retiree. You see, when you enter into retirement, the last thing you want to do is to bank on the stock market continuing to be on its sugar high. When you enter into retirement, you can't afford for a sugar crash to occur within the first 10 years of your retirement. And that is why I'm telling you, if you are 5 years or less from retirement, you've got to start getting serious about the amount of income you need right now. On the current market highs that we're seeing, why not take advantage of them and position your portfolio in a way where it can grow when the market does well, not be hammered when the market does poorly, and generate the income that you desire? There is a way to do that, and we're going to discuss that right after a break. But before we get to the break, I want to tell you why I think that it's possible that the sugar high could lend itself to a sugar crash sooner rather than later. And the big word is inflation. You see, I do not believe that inflation is fully behind us. I want you to imagine a wildfire that is taking place in the woods, and thankfully, just in time, the firefighters came, and they have put out just about every bit of the fire. Thankfully, they're almost done, but rather than turn to finish the job of putting out the smoldering pieces that may still be simmering a little bit, they decide to pack up their hoses and move on to the next job. This is essentially what the Fed has done to inflation. Inflation was off the rails, and thankfully the Fed put their attention to it. And we are so close to a soft landing, but we have things that could quickly ignite that fire back into a raging wildfire. One of those things that is right on the horizon is this port workers' strike that is set to happen sometime in October, I believe the 1st of October. And if that takes place, it doesn't take a rocket scientist or a world-famous economist to see that it will impede our supply. The port workers' strike could cause ports to be congested, less workers unloading ships. Less workers unloading ships means less supply gets through the supply chain. And what this could cause is another dose of inflation. Less supply, more cheap money. This is Economics 101, and it is right in front of us. I don't know that 50 basis points was the best thing for inflation. And I'm afraid that while we may want a soft landing, we may actually be ballooning along the runway for a little bit of time. And whether or not the hands are skilled at the wheel or the controls of the economy, I'm not here to debate that. But I'm telling you that if you're a retiree, do not base your retirement success on the stock market success. And I'm going to tell you how you can start to do that in the next section. We're going to a 30-second break. When we come back, more Retirement Matters after this.
It's 4th and 1 with 2 seconds left in the game. Less than 1 yard separates you from victory. You have the best running back in the league, but your coach calls a Hail Mary.
As silly as that sounds, we see a lot of retirement managers being far too aggressive with your investments when a more conservative play would be a better fit. You have questions, we have answers.
Contact R.D. Smothers Wealth Management, 270-600-PLAN. That's 270-600-7526.
All right, we are close to the end of the show. Somehow we've gotten to the end, and I have no idea how it has passed so quickly. I enjoy talking to you each and every week, but one of the things that I want to give you in this episode is some specifics on things you need to be doing along your journey. If you're 5 years or less from retirement, if you're over the age of 59 and a half, you have the ability to do an in-service rollover. You should seriously consider looking at your options for moving your 401k into an IRA. Inside of the IRA, you have more discretion on what you invest your money in. We can assist you in doing that. You need to be focused on your income in your IRA. How much income do you need? That's step number one. How much do you need? You need to sit down with an income specialist and start to figure out how much income is going to be required in retirement to live the lifestyle you desire. Once you have those numbers, begin crafting your portfolio in a way to where it will generate those numbers. Now, if you're looking in the stock market, I would start looking at things like consumer staples, some industrials. You're looking at utilities, perhaps, maybe some energy sector investments. And then I would really consider putting your money into things that are going to give you dividends. Dividend investing is important in the income phase, but I would also be utilizing things like covered call options, structured notes. I would be putting money into places that will not behave poorly if the market gets really, really bad and stays bad for a long period of time. There are types of annuities that give you serious downside protection with good upside participation. There are things like treasury notes that will give you length of time rates of return that you can guarantee inside of those types of investments. This type of investment strategy is going to give you a peace of mind. From there, you have to build a tax plan. You've got to understand how your money's going to be taxed as you pull it out, or how your money's going to be taxed as you invest and grow that money. In retirement income phase, it's not just about how much money you make, it's about how much money you get to keep. And our firm can assist you in making sure you're not paying too much to the IRS and that you're not losing this hard-earned money to market downturns. There's one last piece of advice I want to give you in the income phase, especially if you're trying to safeguard against inflation and hyperinflation, and that is be sure you take your Social Security at the right time. Taking it at the right time can help you offset the impacts of hyperinflation. We can show you how to do that. Simply give our team a call and we'll set up an appointment to sit down and discuss things with you in person, 270-600-PLAN. Whether we talk to you next week, right here on this same station, or in person in one of our offices in Bowling Green or Campbellsville, either way, I want you to remember one thing, and as always, that is save money, plan well, and live happy in retirement. God bless.
Investment advisory services made available through AE Wealth Management, LLC. AE Wealth Management and RD Smothers Wealth Management are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. RD Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by RD Smothers Wealth Management.